Hey guys, everyone from the major national mortgage brokers to Kiplinger Magazine are all saying the same thing. 2019 is a hot market. Cheap debt, plenty of investor cash looking for returns in the multifamily market have supported the increased property values in the recent years. I'm sure we've all seen that. If you're buying multifamily today, you're seeing cap rate compression, where cap rates were usually in the high sevens are now in the low sixes, and these deals are still selling. But there's chatter of an economic slowdown. We're not seeing it quite yet. And I'm not sure about the exact when it's going to happen, but as long as you remain conservative in your underwriting and you buy for cash flow, you should be okay. Regardless, it's a good time to think about how to protect yourself in case your respective market is at its peak. This means continue buying for cash flow and not appreciation, as I've covered in my previous material, optimizing for cash flow of your existing assets, and picking up major rehab projects that are not too risky for you or for your investors. So here are 5 considerations to think about. Number 1, always be active. This means not sitting by the sidelines or waiting for the cycle to drop. All right. It means you need to look for deals that make sense all the time. In every single market, there's always a deal. And if you're actively engaged with the local brokers, you're attending meetups, and you're talking to other real estate professionals, you're going to find deals. Number 2, focus on the cash flow. As the economic cycle rolls off its peak and begins to decline, active investors will see the value of their properties ratchet down. What you need to remember is that as long as you have those annual leases and you're treating those tenants right, you should cash flow just fine. That paper loss is only experienced if you sell the property. You know, Keep your operations tight. Make sure you have good financing in place and make sure the deal cash flows. That's super important. So put an emphasis on that. Number 3, put liquid cash in illiquid assets. The wealthy know that real estate is a safe haven when a bear market hits. Like I mentioned in the previous point, the primary concern for investors is returns. And so many of these investors understand that owning multifamily properties financed with a fixed rate debt and increasing rents over time will perform well in an inflationary period. There has been case study after case study in how cash producing real estate has outperformed the stock market. The point is, if you're committed to a buy and hold strategy, investing in cash flow multifamily real estate in anticipation of a bear market, it will protect your net worth. Just make sure the property has a diverse employer base around it and some history of making it through a previous economic slowdown. Number 4, people still need shelter. For all those people that have lived through a recession, you know that jobs and businesses disappear, right? It never just hits one sector either. A local economy will contain businesses that are dependent on each other for commerce. Meaning if there's a 500-person call center, those people might go to the local gas station for fuel, they go to the restaurant next door for lunch, they go to the electronics shop to get a new phone. But when a recession hits, all this stops. That call center vacates and all those businesses are negatively impacted as well. But just because those businesses are gone doesn't mean the people are gone. Those people still need places to live. And as we saw in 2008 and even the previous recessions, people turned to renting to stay mobile and reduce their overall real estate footprint because of a job loss or their home was foreclosed on by banks that are actually lending anything. It's worth noting that during these recessions, multifamily real estate foreclosures were very, very low. And occupancy was steady and even increased between 2008 and 2010, according to the U.S. Census Bureau and DataQuick. Number 5, cranes in the air, buyers beware. This is in reference to the oversupply in the market. Rental rates and sales prices rise when inventory is tight. And in previous U.S. recessions, new multifamily construction in many markets just stopped. So new construction lagged behind population growth, especially since the new construction is mainly A-class properties in primary markets like Cleveland, for instance, with all these amenities. And with the market flooded with new supply, it's clear that there will be a supply-demand imbalance that'll take years to be absorbed by that local market. So be aware of these rates and what these new units are commanding in terms of rent. And if they're having a tough time filling them, it could be a sign of trouble. So be aware of what's going on with that. As a real estate owner and operator for more than 15 years who's made his way through recessions, the strategy that served me well is to either buy or turn around existing properties that are in well-located areas, targeted in moderate income renters. I like to hold my real estate for the long term and implement planned increases as I go, making adjustments as I need to. This has served me well in the past, and I expect it to do the same in the future. And maybe you guys can consider that. Anyway, how are you guys preparing for the economic slowdown, if at all? Let me know in the comments. I'd love to hear from you. And you know what? If you like this comment, go ahead and give it a thumbs up. And check out the Bulletproof Cash Flow podcast on iTunes and Stitcher, and leave a review as well. I greatly appreciate it. It's going to certainly help the channel. We're working on getting new content for you guys out all the time, and want to help you build success in the world of multifamily. So I want you guys to be great. Talk to you soon.